Hi everyone. In this video, I'll talk about Part B, exchange rates and currency trading. Starts on page 13. When we developed our model of supply and demand for a currency, we focused on net exports and net capital flows. So in other words, trade and investment purposes as a reason for buying and selling currencies. There are two other reasons discussed briefly in this Gerber chapter as well. One is interest rate arbitrage. Interest rate arbitrage means, just like any kind of arbitrage, it means profiting from a difference in prices. And here the price we're talking about is the interest rate. So profiting from differences in interest rates across countries by borrowing money where interest rates are low and lending money where interest rates are higher and making a profit off of the difference. Recall when we discussed arbitrage in the context of purchasing power parity in Mankiw chapter 18. The process of arbitrage drives divergent prices together, because when everyone is rushing to buy the good or service in the in the low price market, the increase in demand pushes up prices. When everyone is trying to sell the good or service in the higher price market, the increase in supply pushes down the price. So it's no different in the case of interest rate arbitrage. Interest rate arbitrage keeps interest rates from diverging too far apart in different economies. So interest rate arbitrage contributes to demand for holding a currency. There's also demand for currency that arises from speculation. This is from financial institutions mainly, and some individual traders that speculate. In other words, they try to profit by being able to predict future moves in currency. And speculation in general is defined as the investment with the hope of gain, but with the risk of loss. The textbook briefly discusses four main participants in foreign exchange markets, with the most important institutions being commercial banks and foreign exchange brokers, which essentially act as middlemen in the process of exchanging currency. Exchange rate risk is risk faced by any country that either earns revenue in a foreign currency or buys inputs in a foreign country in a foreign currency. It's a risk that occurs when an individual or a firm holds assets that are denominated in a foreign currency. It's the risk of unexpected losses or gains due to unexpected appreciation or depreciation in the value of the foreign currency. So, for example, if you're earning revenue in India and the value of the Indian currency, the rupee, depreciates, then when you convert those revenues back into dollars, you'll have fewer dollars, all else equal, if there was a depreciation in the rupee. So, a way that firms protect themselves against exchange rate risk by hedging. Hedging is a general term that means making an investment that reduces the risk of adverse price movements in an asset. The most common examples of hedging are futures, forwards, and options contracts, although the reason I have the asterisk here is that technically options contracts are a little bit different. I'll explain that in a moment. Futures and forwards contracts are contracts where two parties agree to buy and sell a certain asset at a specific date in the future at a specified price that they agree on today, which is called the forward price. The parties are obligated to carry forth with that transaction. The difference between futures and forwards is that forwards contracts are specific to the two parties that wrote the contract. They're not standardized. Futures contracts are highly standardized. They're written by the exchange, and that makes them more liquid, easier to buy and sell. Options contracts differ from futures and forwards because, as opposed, excuse me, with a future and a forward contract, the two parties are obligated to make the transaction. With an options contract, the buyer or the owner of the contract has the right, but not the obligation to buy and sell the asset. So because a future or a forward contract obligates the parties to transact at the specified time frame and the specified price, a future or forward contract stipulates that the forward price will be paid for the commodity, whether it's a currency or an actual commodity, regardless of what the current spot price turns out to be at the time of the delivery date or the contract expiration. When you hedge, you eliminate the risk of loss by giving up the potential for gain. So a country that is hedging their exchange rate risk, for example, if they're earning revenue in rupees and they're worried that the Indian rupee may depreciate against the US dollar, then they might buy a futures or a forward contract where they agree to sell a certain amount of rupees for a certain amount of dollars at a certain amount at a specified date in the future. But if the rupee happens to appreciate, then that would benefit that company. Converting their rupees into dollars would give more dollars. But if the firm engaged in a futures or a forward contract, they're locked into transacting at the agreed upon forward price. So that's why I say hedging eliminates the risk of loss, because you're protected against a depreciation of the rupee, but you're giving up a potential gain. That's why an option isn't technically a hedge, although people often describe it as such. With an option, you don't give up the potential upside, because if the upside occurs, then you don't exercise the option, and you're basically only out the money you paid for the option contract. Gerber, I went a little bit beyond what was in the Gerber text in this context for this topic. The Gerber textbook only discusses forwards, not futures and options, so I won't expect you to know about those on the test. But the forward market is the market where the buying and selling of currencies for future delivery takes place. Contracts are usually for 30, 90, or 180 days in the future. The price that the currency will be transacted at is called the forward exchange rate in a forward contract. In contrast to forward and futures contracts, if you just buy currency at the real-time current market price, then you're transacting in the spot market and paying the spot price. One last term in the Gerber chapter is covered interest arbitrage. That means, or refers to, a situation where someone who's trying to engage in an interest rate arbitrage uses the forward market to mitigate the risk of a loss.